Thanks for
Okay.
noticing the note. But
You all received by way of advanced information the current decision that needs to be made, as well as the background for it, which it sort of occurred in steps. So I don't know whether Paul, you or Jamie are going to introduce this, but just tell us and begin.
Yeah, so I'll take the lead, just introducing the topic, and then I'll be passing it off to Paul. Before I do that, though, I want to get the PowerPoint up. So if you'll bear with me for just one moment, hopefully this will work. All right. Are you able to see the PowerPoint? I can see Ross and Mike. If one of you guys could nod.
Yes, we can see it, I think.
Okay,
I think
terrific.
we're good here.
Excellent. Okay, well, this morning, the topic that we have in front of you pertains to the management of the university's Tier 3 investment portfolio. And that portfolio is currently, as you're all aware, managed by the UO Foundation for us. Today, there are 3 topics that we wanted to talk to the board about. The first is Paul Weinhold, the president of the foundation, is going to provide an update on some changes that the foundation has made relative to how they manage their assets, including the endowment. The second topic we want to talk about is how those changes present some opportunities for the university relative to management of the Tier 3 funds. And the third topic is the specific authorization that the board would need to approve if we want to take advantage of those opportunities. So those are the topics for today. And with that, I'm going to pass it off to Paul, who's going to talk a little bit about the changes over at the foundation.
Yeah, thanks, Jamie. And what I'll do is talk a little bit about the history and how we got here. Starting with I'll just start with the end. As of July 1st of 2021, the foundation moved to outsource investments to Jasper Ridge, which we believe was an excellent decision. And certainly as part of that decision and part of that, the work that Jasper Ridge is doing for us, it seemed like the logical and best thing to do would be to include the T3 funds in that. Now, sort of stepping back in time, we have a fairly long history with Jasper Ridge from a number of different angles, but most importantly, beginning last year about this time, we hired Jasper Ridge to manage a fairly substantial amount of assets for the foundation, a diversified portfolio that was being managed in an endowment-like fashion. So we've had a history with, or have a history with them. And someone who you all know, I believe, is Jay Namiet. Jay retired, announced his retirement over a year and a half ago, I guess now, to be effective June 30th of 2021. The intention the entire time was to move forward with the group that we had in place and the transition plan that we had in place. But with the relationship and what we learned about Jasper Ridge, the quality of service, the access to markets, the expertise, the background, compliance, risk management, tax audit, ESG, it became apparent that we should probably look more closely at an outsourced model. So I pulled a group of trustees together to oversee the process and engage in the process. And we looked at other firms. We obviously looked at what our opportunities were internally, and then Jasper Ridge. And frankly, it just became very, very clear that Jasper Ridge was the right decision would be to move the investments to Jasper Ridge. Again, to maybe repeating myself a little bit, the things that were important to us, certainly investment return is important, and I'll get to that a bit later. But the things that we care about the most are access to markets, risk management, controls, ESG is very important, compliance, tax, audit, and those are areas that we focus on internally. And by comparison, there was no way that we could ever have that type of service and that type of access to that expertise internally. It would just be too much for us to fund. The access to markets, because of their location, because of their size, Jasper Ridge just has they just have better access to the markets that can help with the performance of the endowment. When you add all those things together, And, one of the other things I should say is because of their size and because of their expertise, the cost of hiring managers is much cheaper. So in short, we get way more service, way more control, way more protection for the endowment, better access, and we literally save millions and millions of dollars. That's just on I would just call that on the operational and cost side. If you look at the 10-year performance of the Willamette pool, previously what was the Willamette pool that was managed by the endowment, if you look at over a 10-year period of 1, 3, 5, and 10 years, Jasper Ridge has outperformed the endowment by probably 150 to 200 basis points. So if nobody can predict the future, and there's investment performance, I have absolute confidence that Jasper Ridge would continue to outperform what we could do. So again, for us, once we really boiled it down and looked at what we got, the expertise, the savings, and the investment performance, quite frankly, it was a very easy decision. And again, coming back to the subject at hand, we began the discussions back in the summer, I guess, in June, about moving T3 and to have the same access to all of the same things and performance and being managed in the same portfolio. And again, it just seems like it's the best thing to do for the university, obviously the best for the foundation, and combining the two makes a tremendous amount of sense.
Any questions for Paul before we move on here?
Yeah, Paul, what kind of staffing are you keeping on to oversee or monitor their activities?
Well, we have, from an operational standpoint, we have a significant staff in Kelly Bosch's department in our finance group on the accounting and tax side. They're working with them, frankly, almost daily. We have a person in Tom Yao currently who is kind of the liaison between Jasper Ridge and the foundation, and certainly the investment committee of the foundation. So we have multiple members of the staff working with Jasper Ridge on a regular basis.
Paul, you talk about the benchmarks that you're using in Barclays. Are those ones that you're going to continue to use as benchmarks? Have those been in place? I can't remember from the old days. Or are you using Jasper Ridge benchmarks? How are you managing that and the balance of risk?
We are. I'm going to try to answer this in a simplified way. The risk-adjusted returns, we're going to pay very close attention, obviously, to the risk of the portfolio. It is managed as an endowment, like it is an endowment portfolio. So it's obviously less risky. We're going to, as far as benchmarks, we're really in the process of identifying what those are. We're still comparing them to our previous benchmarks, but in the October meeting and maybe even the March meeting of the foundation trustees of the investment committee, we're going to narrow down what the benchmarks are.
Will the function of the investment committee of the foundation change, Paul?
Chuck, I actually think that it's going to sound odd, but I think that the responsibility of the investment committee actually gets elevated. I mean, we have outsourced, so there's not going to be obviously any direct investing, but certainly from a controls, evaluating based on benchmarks, risk profiles, it's going to be the investment committee will need to be very engaged in this process. They just won't be making investment decisions. The investment decisions will be made by Jasper Ridge.
Any other questions for Paul?
Yeah, Paul, as you think about Jasper Ridge, is there like a minimum period of time you stick with them, and have you and the investment committee thought about what are things that would lead you to leave Jasper Ridge?
Yeah, well, Marcia, we have contractual agreements on how we could leave, and we obviously can if either side chooses that it's not the right place. I think that would be. We certainly don't have any plans to leave Jasper Ridge, and based on the certainly the 1 year of experience that we have dating back to last year, that the service is incredible. The expertise is incredible. The resources are incredible. It's hard for me to come up with a reason why we would move, but we will always be evaluating their performance and service levels and the quality of support that we're getting.
Have you shared with us, maybe you did at the last meeting and I was dozing when you did, but have you shared with us Jasper Ridge's investment return record for university foundations?
I don't think I've actually shared that, Chuck. I don't know that we've done that, but we can show what, I mean, we can show what we've done, and we can show what their portfolio, they have a portfolio that is an endowment type portfolio. It can be different for every client. It can move a little bit, but for the Jasper Ridge Diversified for tax exempt, we can absolutely show the comparative.
It'd be interesting to see how they're doing,
Sure.
even if it's an aggregate statistic of some kind.
Yep.
Paul, I wanted to add something just for clarification, maybe just for on the record, is really, we had an outstanding staff led by Jay Namiet with our investment portfolio, and with his departure, really what we're doing, and this is I guess a question or statement, but you can confirm or amend. We're really taking this as an opportunity to replace the team that we have with Jay's departure with a 100-person investment firm that manages $30 billion that will really perform the same role. They are going to select qualified managers, give us access to that, oversee the portfolio. So really it's a chance to enhance the number of professionals, investment professionals, at the same time as reducing cost at a timely period. Is that a fair way to say that?
That is a completely accurate way to say that.
Paul, can you just remind us, the group, what the reporting schedule from you or Jamie on tier 3 activities is going to be?
Yeah, they're going to be the same that they've been in the past. We get together quarterly with updates and provide returns, and obviously have just deeper discussions about where what the asset allocation is and the risk is. The reporting I would say the reporting will be the same timing wise and probably more robust. And I feel like I need to go back to Marcia's question about leaving Jasper Ridge. One of the ways that we're thinking about this, by putting T3 into this portfolio, it will be a separate account in the portfolio. So if the university decided, hey, we want to do something else with that, we can just move it out.
Okay, any other questions for Paul? Jamie, do you want to?
I have a question, Chuck.
Okay, go, please.
So, Paul, as you know, in order to enter into this agreement with Jasper Ridge, we've needed to change, and the board would be today changing one term of our investment policy, which is respect to derivatives. Do you have a sense as to how big a change that is in investment strategy and how much it would change our risk profile, the T3 funds?
Yeah, I would say it would be very, very small, and we're fortunate to have Cayman Seacrest here from Jasper Ridge, so Cayman might be a better person to answer that question.
Hey, good morning. Pleasure to be here with you. I'll do my best on the derivatives question, but we could obviously there's a whole broad array of different derivatives and different paths we can go down, and I don't want to go too deep, but please feel free to prod me to do more. Congrats on the big win this last weekend, by the way. That was pretty exciting for the school and for us. You got a number of Duck fans in this office here down in California. So really, derivatives are used in our portfolios in two broad ways. One is the underlying investment managers that we select for a portion of the portfolio. And it's a relatively small portion. It's about, to use some numbers, 10 to 20% of the portfolio. Some of those managers, not all of them, but some of that 10 to 20% will use derivatives for a variety of things. They're certainly going to be using them to do a lot of hedging. And some of that hedging is risk reducing, but some of it's also an attempt to provide some excess returns along the way. You could, a simple example you could think of for that would be if you want to reduce your equity exposure, you can short equities. You can also go out and try to find individual equity names or companies that you like the least and short those. And that would both reduce your equity exposure overall to the market, but also try to add some excess returns if those companies actually underperform. There's some of that that goes on in the hedge funds that we select. There's also certain speculation that is done from some of our managers. So that's done via derivatives. And it's usually done to gain, some what we call asymmetric returns, which means you can make a lot if you're right, and you can't lose a lot if you're wrong. And the easiest example of that is if you buy an option, you know exactly how much you can lose. The maximum amount you can lose is just the cost of the option. And then the upside is unlimited if things really go your way. And we do have some managers who engage in some of that for a portion of their portfolio. So we underwrite those managers for those full suite of options. And that's a part of the entire underwriting process that we go through with each manager, and thinking about what are the risk guidelines that we want them to stay within, along things like overall amount of leverage, if they're going to be doing any option selling, which is pretty rare these days, but if they are, how much of that they're going to be doing, because that's the case where you can really get into trouble with derivatives, along with the leverage piece, of course, and things like that. And so we monitor those reports monthly. We've got, snapshots for each manager, and their risk exposures, every month, and we just go through those. And most of these are guidelines, and so if they trip them, they'll need to let us know anyways. But some of them are a little bit softer, and we just need to monitor, if they're taking too much risk. And so that's a small part of how derivatives will pop up in the portfolio. Then the other large portion is we actually invest in derivatives ourselves, and these are very simple bread and butter derivatives. And the way we do it is we want to be able to add or subtract overall risk to the portfolio kind of at any given point in time. So sometimes if we want to have, say, X% equity risk in the portfolio, that X isn't going to change too much. We're not trying to time the markets in any real way. That's a really small part of what we would ever do, thinking we can kind of outsmart the equity market overall and on a daily basis. But whatever that X% is of equity risk that we agree with, Paul, Kelly, and Tom, that we want to have on, over the long term, we might not get the X% from all the underlying investments we're making. We might get X% minus 5 or X minus 5%. And so what we can simply do, instead of forcing ourselves to increase those bets that we've made with managers in a way that might not feel comfortable, we can just buy 5% of, the S&P futures. It's kind of the most liquid equity futures in the world, or 5% of interest rate derivatives if we're not getting enough duration exposure from the underlying investments we're selecting. So for there, we're not doing any option-like structures. We're simply buying, and these are all funded with the cash we have in the portfolio. And it's a part of the whole, all the liabilities that we bake into how we can manage the portfolio effectively. We'll be buying kind of the most bread and butter liquid derivatives there are out there, primarily in interest rates. So the 10-year future on the 10-year government treasury bond would be an example. And then the S&P future are the two most prominent examples. We do a couple of others, but they're along that same, they'd be in that same menu of options.
Hey,
so let me pause there really quick. Good.
Yeah, Cayman, I have a question for you. I want to make sure I understand what you're saying. It sounds like the way you described it is Jasper Ridge is really using derivatives just to keep it at a target. So to make an analogy, we have a car that's supposed to go 55 miles an hour. And if it's going 50, you would use a derivative to push it back up to the target of 55, as opposed to using the derivatives to move it off target to slow it down or speed it up. You're really using them to keep it on the target. Is that accurate?
That's exactly right. You described it perfectly. Yep. So another simple example is if we find a great private equity deal, maybe a secondary in private equity that we think is very attractive. And that's going to add equity risk to the portfolio when we fund that. Well, the easiest thing to do, instead of looking for managers that we might, need to trim from, and that creates transaction costs and maybe a little bit of headache for the relationship with our GP, it's really easy for us instead to just sell, if it's a 1% position, sell 1% of equity futures. And so our equity risk is unchanged, but now we've got this great investment in this private equity deal. And that happens relatively frequently.
Has there ever been a time, or would you ever anticipate a time, that you, Jasper Ridge, would use derivatives to move off of target?
Yes, absolutely. And so, it would be, actually, I should clarify, not off of target, but our targets might change from time to time. We might want to take slightly less equity risk than the long-term target. So I'd call it, we would keep them consistent with our short-term target, but it might move from the long-term target. We don't do that often, and we do that with a lot of humility, but from time to time we do that. And for example, today as we sit, we have a 5% underweight to public equity markets, broadly speaking, relative to long-term targets, given some of the valuation and concerns we have around that. And that's about as big as a bet as we'd make in a market like that. So still not very big, but just to clarify a little bit.
And you use 5% as a nominal number, meaning that if 50% is the target, you would go down to 45, not 5% of 50%.
Correct. Yep.
Okay.
So I appreciate that explanation. I guess I wanted to check in with Paul, though. I mean, compared to today's environment, in which under years-long OUS policy, we do not invest in speculative derivatives. How much do you think this is changing our risk profile? None at all, or a great deal?
I don't believe it's changing our risk profile at all. Or if it is, it's very, very, very small. Cayman, would you agree with that, based on your knowledge?
That's right. Yeah, the overall risk profile shouldn't change in any meaningful way. We should be able to tailor it a little bit easier and be a little bit more nimble there. But the overall risk, in terms of if markets really sell off or if markets really rally, sort of how much the portfolio we're gaining will either make or lose in those scenarios, should be unchanged.
Any other questions along the same line or a different line for either Jasper folks or for Paul, or do we want to have Jamie go forward here a bit? Jamie, I think we're ready for you to take this.
I will keep us rolling, and obviously if people have questions do come up, we can always go back. So moving along, and we've already mentioned this, but I'll just highlight, as we think about the university's T3 portfolio, we believe there are very significant benefits of moving it over to Jasper Ridge and investing it with the foundation endowment. The first kind of point here that's highlighted is the fact that, as Paul mentioned, Jasper Ridge has a tremendous team with 100 professionals, and by doing this, we would gain access to that infrastructure and that expertise, which would be fantastic. We also, when you think about the scale of the portfolios, the T3 portfolio is sitting at about $100 million. The foundation is closer to 1.2 billion. And so there's very significant scale that by combining our smaller portfolio, this would actually reduce risk, because it would enable us to better diversify the investments that we're making, because we have a larger pool, and also to gain access into instruments and markets that might not typically be achievable with a smaller fund. And then finally, as Paul mentioned, there's the Foundation's Investment Committee is providing oversight on these funds. Jasper Ridge is providing oversight on these funds. We would be looking at the performance of these funds. And so we would get additional, I think, governance oversight. So some very, very significant advantages of moving forward with transferring the funds over and combining them from an investment perspective, not an account perspective, but an investment perspective with the endowment. As you'll see from the materials, or I should say, in order to do this, one of the major things that we need to do is we need to be providing consistent guidance and direction to Jasper Ridge if we're combining these funds from an investment perspective. We need to make sure that all of our guidelines and principles that we're providing to Jasper Ridge are consistent with the foundation. And we've done that in the materials that you'll see. We've made several changes to our Treasury procedures, as well as with the contract we're working with the foundation that will enable us to align those goals and those guidelines. The one area, as mentioned before, that we do need board action on if we're going to move forward has to do with specific authorization around derivatives. And our Treasury policy, which we put in place when we did the governance transition, essentially outlined that if we are going to use derivatives, we need to have specific board approval to do so. And as many of you will recall, in December of 2016, the board did authorize the foundation to use derivatives in particular hedging contexts. What's being proposed today is to broaden that authority to allow the foundation and the fund managers, in this case Jasper Ridge, to use derivatives on a broader basis to encompass the broad array of things that Cayman outlined, not only the ones that are specifically a particular hedge in a particular instance. And so that is the proposal that is before the Executive and Audit Committee today.
And as all of you know, the resolution is one of the early pages in the material you got. Are there any questions about at this point, about the intent or the specifics of the resolution? Or I don't hear any. Any other information, Jamie, you want to offer before we decide on the resolution?
No, I mean, I would just emphasize that I think this is one of those places where I feel like we have an opportunity with our smaller fund to take advantage of the significant partnership that the foundation's put in place. And so to me, it just represents a place where we're acting strategically and smartly to try to leverage all of the resources that we have at our disposal at the university. And that includes working with the foundation where it makes sense to take advantage of the expertise and partnerships that they're able to bring to the table.
And before we vote, who were we hearing from Jasper Ridge? Was that Tom or?
That was Cayman. And
Cayman.
I don't know if there's more that Cayman you have to share or would like to offer Paul at this point before the committee discusses the resolution or votes on the resolution.
There's nothing else that we could add, Jamie, unless there are questions.
Okay, well, thank you for your help. I'm sorry we didn't introduce you at the onset. Okay, for the resolution, do I hear a motion?
I'll move it.
So move. Is there a second?
Second.
Are there any final questions or considerations before we vote? Okay, all those in favor, an aye?
Aye.
Aye. Any opposed? Okay, I have one last, the motion carries. I have one last question. I guess, Paul, for you, but I'm asking on behalf of President Schill, because I'm trying to coach him to let me ask these kinds of questions. When we do this, will you give him more money each year? Hey, Mike. Take your time, Paul.
We have,
Thank you.
We have been able to manage through some really rough times and provide some significant financial support to the university, and we'll continue to do so. So yes.
Cayman, you heard that. Boy, we're all in now.
I just saw the spend rate go up. I'm happy.
Okay, Mike, any other comment you want to make? I know we can't introduce new business, Angela, but Mike, any other comment?
No, just wanted to thank all of you for today's meeting, and I'm excited about the Jasper Ridge partnership, and just very excited. Thank you all for those of you that attended the game and rooted us on. We needed all of you there, and we're off to a great start for the school year begins in 2 weeks. So we're moving forward.
It was a great Saturday for the Ducks, and incidentally came in fourth Stanford. My gosh, couldn't have happened to a better group. Okay, I think we're in adjourn. I'm sorry?
Agreed.
Agree. Okay, I think we'll adjourn our meeting. Thanks, everybody, very much. Take care. Bye-bye.
See you next week. Bye.